Hey, everybody. Welcome to another episode of the Under the Hood podcast, hosted by Stallion Capital. I'm your co-host, Tim Douglas. And today on the show, we have Andrew Jensen, who is a senior wealth advisor and the director of alternative investments at Zermatt Wealth Partners. Andrew, how you doing?
I'm well. Thank you, Timothy. Happy to be here.
Of course, we're happy to have you. And we always like to start the show with getting to know you a little bit. So if you could tell us a bit more about yourself, your journey as an advisor, and your firm, that'd be great.
I mean, sure, who doesn't like to talk about themselves, I guess. So our firm, Zermatt Wealth Partners, is a comprehensive wealth management firm. You probably see that on a lot of financial advisor firms' websites. Let me close my email. So what does that mean? It means we cover really everything in a client's financial life. We are the nexus of their wealth. So from portfolio construction and investment management and behavior management to ongoing financial planning. Financial planning is an ongoing process for us, just like portfolio management. Tax code changes, people's circumstances changes. It's really important to have revisit that baseline and keep working that financial plan over a client's life with us. We do estate planning advisory work, so we don't do the technical contracting, but we analytically underwrite the assets, assume rates of returns on the various asset classes, and then give someone really a good estate tax picture, and then identify and introduce the appropriate strategies that we think best mitigate estate taxes in accordance with the matriarch's wishes. And that can also include charitable giving and charitable structures and foundations in terms of structuring those things for them. And then we obviously do asset protection, insurance advisory work. We're not a big insurance producer. Unfortunately, I think insurance is often sold, not bought. So it's important to have someone, particularly with a business owner or someone that might have some sort of very acute risks in whatever they do professionally or in their life, that you're auditing that umbrella insurance, you're looking through all their assets. So really what we do is we introduce every year to our larger clients, like an independent wholesale organization, and they'll come in and we use a different one every year and they'll audit all that insurance and make sure it's structured properly, there's no holes in it, or they're definitely not overpaying, right? They're not overinsured. So, and that's part of the financial planning process, right? Identifying, is there any funding gaps in your life at this stage of your life for younger clients? Or ultimately, I think insurance is a really good estate planning tool in addition to, or even sometimes more optimally than, an irrevocable trust. So death benefits pass on tax-free to the estate. So all the growth and a private insurance policy, if you grow them properly, all that growth can be tax-free to the estate. So that's how we look at insurance. It's really those four areas that we're focused on. We're a team of 8. We have 3 physical offices. We're bi-coastal, so we have San Diego, California. I live in Orange County. We have a large growing client base in Southern California. And then we have an office in Charlotte, North Carolina. And we have another large office in Wilmington, North Carolina. So we're bi-coastal. We have about $330 million of assets under management, which we're definitely growing diligently right now, very specifically. And we cover clients on a national basis. So I have clients in Connecticut, New York, Alabama, Texas, North Carolina, obviously California, Arizona, you name it. Most of the states we have significant relationships and clients there. So it's more about the type of client. Do they have the needs that we feel like we're specialized to solve for? Not really geography, right? So things like this, it's so easy to get to know someone and then I'm on a plane, every quarter visiting clients. So that's kind of a high level view of the business. In terms of my background, most of our team members are kind of lifelong financial advisors. And I think what makes me a little unique is I kind of backdoored my way into the industry. So I have a really diversified background, which I think brings a lot of value to the team and my clients. So I haven't just lived in this silo my whole life. I was at a long short equity hedge fund right out of college that really taught me the capital markets, fundamental analysis, quantitative technical analysis, really how to track capital flows, trading flows. And that's really where I started studying the macroeconomy and the microeconomy. That was a really good experience for me. And then I got into commercial real estate investment banking. I did that for 5 years. So I really know how to underwrite instead of like studying your return on your stocks and your bonds and things of that nature. I really started learning discounted cash flow math and how to model things. That was my Excel university, let's call it. So how to put a financial model together, and also how to understand internal rates of return, multiple on invested capital. So kind of that private equity math and how to look at the world in terms of performance that way. And then I obviously learned like all the major food groups in real estate and how to capitalize real estate from equity, preferred equity, all the way down to the debt, and really how to underwrite the expected return of a real estate asset and look at a rent roll for different types of asset classes. So real estate underwriting, I think real estate's really important for hiring with clients. It's very tax efficient. It has a lot of benefits as a real asset. So we're big advocates of it. So I think that's a skill set that I have. And then I was actually an institutional investment consultant to high-end wealth management firms for 11 years. I worked at a private equity hedge fund platform, and I helped my high-end independent advisory teams construct private equity and hedge fund portfolios. That's where I really learned private equity. What are the names you want to be in? It's not the big ones that everyone knows about. There's another tier underneath that aren't those mega funds, in my opinion. How to think about vintage diversification, how to mitigate risk, how to manage the weird cash flows of private equity, and how to do that due diligence on those funds, which we're a big believer in high quality funds. And then obviously when you work in portfolios of hedge funds, that really expands your knowledge of the public markets, commodity trading, systematic trend following, global macro, long short equity. And beyond that, I think that experience really, my clients were very successful independent wealth managers. So that really, I was just a student of wealth management success. So all the best practices that these different teams employ, maybe some of the bad practices you learn to avoid in terms of personality traits and behavior, or just, integrity and things like that. Generally, the successful firms are doing things really well, operationally, scalability, how they treat clients, how they treat people. So I was a student of that for 11 years. And then one of my clients actually buys wealth management firms at my old firm where I was a consultant. And he bought a firm in San Diego, needed someone to step in. So that's how I crossed over. So very long story, but that's my background.
I love it. No, I was curious about the crossover, and that makes perfect sense. You knew a guy who buys some, and he trusted you. He liked your knowledge and had you step in. Now I'm curious, you guys have a team of 8, 330 million assets under management, and you do a lot. You do a lot
Yep.
for clients. Is it that each individual is specialized, and so clients have more of a team experience when they come in, or is it more of a one-on-one experience and you guys have a deep knowledge across all the things that you do for each advisor?
Yeah, there's really let's call it 4 team leads. And I'd say all of us have a little different specialization. Obviously, mine's on the investment, financial analysis, alternative investment arena, right? And then I also developed specialization in more advanced tax mitigation strategies because I tend to focus and have a network of higher net worth people. But then, a gentleman in Wilmington who's a team lead is the biggest financial planning nerd. And he would love me to tell you that about him that you could ever imagine. So yeah, so it's definitely a process where if there are items we can't handle, then there's a collaborative approach. And then my managing partner has been in this business forever. So, he's seen and done it all. He's really good, when there's a crisis with a client of really coming in, if someone's in a really big tax situation that we didn't put them in, I'll say that. But if they are, we happen to come into a client that's how we come into the relationship. His network's phenomenal. So he can dial up a really good tax attorney for that specific need pretty quickly. And we can get the right resources in place. And he's just got a ton of experience. So, and then we have a gentleman also on the East Coast who is really strong in insurance. He started as an insurance producer. So he works on a huge couple cases a year. So that's not really my bailiwick. I understand private insurance really well, but that's where, so if you're getting the grasp of it, there's kind of this natural cohesion. And then another gentleman in my office was an old school stockbroker, but is really good with clients and has seen everything, right? So there's a lot of gray hair. And then I'm kind of, the most youthful person in terms of the team lead experience. Does that answer your question?
Yeah. It sounds like huge depth of experience. If there are really crazy situations, you can collaborate, but for the most part, you guys have some expertise to talk to clients on most of the day-to-day stuff
Sure.
in a one-on-one
Yeah.
fashion.
And there's great software now to help you develop all these frameworks to talk to people and guide you through the experience. So that, it's not like you're in some black hole as long as you have the right systems and the right structures in place.
Yeah, absolutely. Well, tell me where you go to kind of stay up to date with the latest market trends and financial strategies.
Yeah, I think what I learned at the hedge fund, what they would always tell us is like young developing traders and investors is don't trade the news. So I think first and foremost, obviously we pay attention to the news. My only flavor that I really listen to is Bloomberg surveillance. You gotta, news is conflicted. People pay to be on shows. There's a lot of different opinions. And I'm sure there are traders that day trade the momentum that is that news. That's, if you look at like GameStop and things like that, at the end of the day, we just try to be 100% data driven. So news can give you context. You got to pay attention to it. But really what we focus on are 4 core data sets. And we have what we think is a really proven, robust, data-driven investment framework that's very disciplined. So the 4 data sets that we think are most important, and it's the lens through which we construct and rebalance and tilt portfolios on the public market side, particularly, would be one, like valuations. So what segments of the markets are expensive, and then also like expected forward returns compared to the different sectors of the market. So for example, the 10-year U.S. Treasury compared to large cap U.S. stocks. So that's the valuation bucket. And then we definitely pay attention to the business cycle, but mostly within the business cycle, what are the forward-looking economic indicators doing? How are they trending? And a specific subset of those that are a little less noisy and kind of a mosaic, because obviously when a recession's called, it's old news, right? It's based on 2 quarters of contraction, and that's already happened. That's in the rearview mirror. So we pay attention more to what is the trend. Like, for example, we're in the 20th month of contracting forward-looking economic indicators, producer manufacturing index, other items. So that's like very recessionary. On the other hand, jobs have been super strong. That's a lagging indicator, and the consumer is the last to go. So what we're looking for right now is that bottoming and that forward-looking economic indicator, and paying more attention to that, and that will inform us where to rotate capital based also on valuations. And then don't fight the Fed monetary policy, whether they're restrictive, and we think they're very restrictive right now compared to growth rates, or neutral or accommodative, lowering rates or providing other sort of open market actions. That is another really important piece of the puzzle. So where we are in valuations, where we are in the business cycle in terms of trending, and then what is the Fed up to? And then the last piece, which we think is pretty unique, is having a really robust trend-following quantitative lens that takes all the emotion out of it, that really helps us pay not attention to the news, just pay attention to the data. The market is not the economy. The economy leads the market a lot of times. So yeah, that's a really, I think, important element in terms of identifying when to kind of dip your toes or rotate more in emerging stocks when they're really undervalued, but they've been in a really bad downtrend. It's really important to have that quantitative, systematic trend following piece, I think, to put it all together. So that's that. Yeah, in terms of where we get information. In terms of like industry news, I think it's really important to have a good peer group to lean on. There's always things that you don't know in this industry and that you need to learn. So it's good to have a group you can lean on that you don't compete with. It's really good to have a network of specialists in the tax, law, estate planning. And then we think it's really important to participate in the right industry events where there's continuing education, there's thought leaders, and just try to really be passionate about the industry in general because things are constantly changing. That's kind of how I keep abreast personally.
So industry news comes from the network, and then you're looking at valuation, business cycle, what the Fed is up to, and then using that data approach for all the other information.
Trend following. Yeah.
I gotcha. And I want to know a bit more about kind of how you will rotate based on certain scenarios in 2024. Sure. Can you walk us through that?
The S&P was really exciting last year, right? But if you look at the 24 months, the 2 years leading into December, the top performing asset class in the public markets was short-term treasuries or cash. No one really is talking about that or has even thought about it. So we have a really similar setup if you tie it into the framework where the forward expected return on the 10-year U.S. Treasury is now greater than the S&P 500 or large cap stocks. This is the same setup we saw going into the end of Q3, Q4. So and then if you coincide that with the fact that forward-looking economic indicators are in a significant downtrend and not bottomed yet, that makes you think there's, you could keep really expensive S&P 500 or certain segment of the stock market for a long time as long as there's above trend growth in earnings. But the second the coincident and lagging indicators start to catch up with the leading economic indicators, there's a good chance we will have a real contraction economy. You're going to have earnings contraction, not growth, and things are priced to perfection. So like the longer we march out on that axis of time and that extreme evaluation, the harder those alligator jaws can snap back. So that'd be an example of why, like, one, you have to systematically quarterly rebalance portfolios. You're automatically taking profits. You're selling high and buying low, right? You're taking from parts of the portfolio that have done well and you're selling them to losers in the portfolio. So you're naturally kind of diversifying in that way. And then to tactically make the decision of, okay, we're monitoring the trend in large cap stocks. We have these other parts of our framework. We know the Fed's restrictive. That's kept us in quality, but ultimately, like in the end of 2021, there's a certain point in time you want to rotate to other low volatility factors and things of those nature. So that's kind of how the framework guides us. Does that help?
Yes, it does. It was
The biggest takeaway, this is the same setup from a valuation perspective and a forward-looking economic indicator perspective as we were in Q4 of 2021. And we all know what happened in 2022. It's going to happen again, but it's... So like be diversified, look beyond just the S&P 500, have a process, have a framework, rebalance, and then think outside of the stock and bond market.
I gotcha. So speak to that diversification a little bit outside the S&P 500 and the bond market. You're not talking about individual stock picks, are you? Are you going to alternatives with that? Are you going to other investment opportunities?
Sure. Yeah. So in the public markets, more like factors: quality, momentum, small cap, large cap, growth, value, international, growth and international, value international. So that's the public markets. And bonds, it's really three things: high yield, long-term U.S. treasuries or intermediate, let's call it 7 to 10 year, and then 1 to 3 year T-bill. You really only need those factors, I think, in a bond, factor-driven portfolio. And then we build cash cash is king. Everyone's excited about their high yield money market funds. As soon as the Fed goes down, that's gone, right? So we've been managing more and more cash management accounts for businesses where we build them a bond ladder. We do the same thing for clients, the household, like they're the enterprise. But in terms of alternatives, yeah, I think that one of the biggest themes that I believe in and a lot of people at our firm believe in is that private finance, private markets have been continually and more disrupting traditional finance. So if you look at 2021, the only things that were really up in portfolios were commodities, specifically energy commodities. If you had something that was short interest rates, and private credit and private real estate was actually up, and private equity was barely down. Those elements of the portfolio, and we'll get into the different segments of what's disrupting traditional finance. So to get to that theme, if you look at like bank lending, they have all these capital ratio nightmares they're dealing with in 2023 Q1. Where the Fed had to step in and rescue and backstop all those capital losses. They have consumer lending divisions, which are having a huge uptick in auto loan defaults and consumer credit card defaults. They have a competing wealth management divisions. Just look at lending, for example, and how you want to participate in lending. They have a wealth management unit. They have quarterly earnings they have to deal with. And since the financial crisis, they have had more and more evolving regulation they have to adapt to. So do you want your money lent in that lens? And is it easy to lend in that lens? Or would you rather give money to a private fund? All they have to do, they have patient locked up capital. All they have to do is make loans within their specialization. Let's call it software, real estate, technology, whatever they do, they bring in money, they make good loans, and that's eating more and more of the market share at the banks. Banks lending was fairly healthy last year, but the standards by which they lent were insane. No one could get a loan. I have clients with phenomenally booming middle market businesses. They're getting horrible debt because like the big banks aren't going to make that loan to them anymore. So what does that mean? That means there's a vacuum for private capital to fill that void, and it's growing. That's why private capital is growing so much. So we're a big advocate of that. And then just within the equity markets, companies don't really need to go public anymore. There's like this entire ecosystem there has been for, let's call it 15 to 20 years. That's just really grown more and more and more, where if you're a startup, there's a whole venture capital ecosystem of collaborative capital that can help you grow. There's no quarterly earnings that you have to meet and deal with. There's a very short-term thought process behind how most public companies have to be managed, because we have day traders, we have analysts, we have short-term critics, right? So you really got to constantly hit those quarterly numbers and think short-sighted, in my opinion. You have growth equity. So as soon as a private company has revenue, they've got products, they have customers, they're established, but not super profitable. Well, how about taking on capital that, yeah, it dilutes your ownership just like stocks would, like going public. But at the end of the day, like that partner has a 10-year window or a 6-year view or business plan with you to not become profitable, to grow as much as humanly possible and take market share, to just be super long-term versus the market wanting you to be all of a sudden cash flow positive. So, and then all the way to buyout. And we're seeing a bigger trend. Some of the biggest software managers that we work with forever, they can do like massive take privates now. So I don't think this trend's going to continue. I think higher rates have really stopped the capital markets. So if you look at private equity right now, it's gotten pretty stagnant in terms of we've had distributions from our portfolio in 22 and 23, but the pace of capital call has really slowed down. There's no exits. And then there's also like an anti-M&A regulatory regime both in Europe and here. So there's no IPO market. That window's been closed. So basically what's happened is private equity funds have had to just hold on to these businesses longer. It's drawn out that time window. We think it's actually a really good opportunity to create liquidity in private equity, so to do secondary private equity transactions. I think I kind of went on a tangent.
You did. You did. Interestingly enough, though, I want to keep hearing. So talk to me about that secondary private equity market, how that liquidity process would work.
This really kicked off, and I've never been excited about secondary private equity. We use it to give someone new to us, new to private equity, instantaneous exposure. So a private equity fund goes out and buys LP positions in what are called primary funds, what someone committed capital to and gave their money to, and they built a portfolio. And what's unique about it is, one, you can get that seasonality and that diversification. You know, some of these large secondary private equity funds, they have like 2013 vintages in it. So what they're able to do is really underwrite every business that's in the portfolio. They're often far along in their business plan. It's just the LP needs out of the structure. So that's one part of secondary markets. And if you look at large institutional investors, they have very strict, an endowment can only own so much private equity, be committed to so much private equity. So when their stocks and bonds are down in 2022, they're forced to come up with liquidity to right-size that portfolio. They're then able to get a discount in that secondary private equity position. And then there's a growing trend of what are called continuation funds. So like particularly when this time window gets drawn out, where a good manager could say, hey, I have this asset or two, we're going to put it in a continuation vehicle. Existing investors can participate or not. And then new money can come in and take out the old investors. So that's another area we've been committing capital to. There's always opportunity. You just got to find it.
Yeah. That makes a lot of sense. I saw we jumped into alts. That is a section of the podcast we love to talk about, but I do want to backtrack a little bit, and we can kind of take these questions in stride with alts and, equities and stuff in consideration. But when somebody's thinking about gearing their portfolio more towards income versus asset accumulation, what's really the difference there in this market right now with how you would construct those two portfolios?
At the surface level, there actually is income you can get in the public markets, which is pretty nice. So, not to talk too long about how you build a bond ladder for a retired person, but I would encourage people to take a little less income today for locking in longer term. So that's kind of the public markets. It's here. I think that in the private markets, you can get such a substantial yield at better terms than ever from what we're seeing from our private credit managers, both in private corporate credit, royalty finance, claim litigation finance, and particularly in real estate, where everyone's been reading the Wall Street Journal about, this looming commercial real estate debt wall. It's real. I mean, it's happening. There are people walking away from loans. There are a lot of loan restructurings going on, and it's only going to continue and heighten. So I think there's been a unique opportunity. I think private credit particularly can earn double plus the return of long-term U.S. Treasuries. So if you're willing to give up some of that liquidity, I think it's a crucial part. So if the financial plan is really dialed in for the retired person, or they don't ever even touch the corpus of their portfolio, they're a larger client, whatever the case may be, there's always a place for private credit, I think, in clients' portfolios. I think it really lowers the volatility, eliminates the interest rate risk. These are short-term loans. it really enhances their return. And they're getting, like I said, we're seeing better terms, better loan to value on better borrowers than what you've seen before in private credit. I don't know if that answers your question.
Yeah, no, that does. So on the income side of things, really gearing towards that private credit, but it sounds like there's some accumulation opportunity in the private markets as well. Just wanted to see if you wanted to speak to that a bit more, or if you feel like we covered it well enough.
Yeah, I think if you look back over time and, we'll see what the future holds, but the private equities outperform the S&P over if you look at it from multiple lenses over quite some period of time. I do think it's still going to be a return enhancer. I think the longer we've dragged out in this capital markets frozen period, there's probably more and more opportunity to invest in good private companies that are doing down rounds through good funds. So yeah, I think that trend will continue as soon as capital markets open up. But more importantly, I think if you think about private credit, private real estate, real assets, we use something called structured notes. The return enhancement is one element of why you target some of those strategies. But at the end of the day, what we're trying to do is bring in structural and unstructured cash flows that are totally independent of the stock and bond market to the portfolio. So if you look at someone who's drawing on a portfolio in retirement, per se, it's the opposite of dollar cost averaging in. When you're taking portfolio money at extreme lows, because to live off of, you destroy the health of your financial plan. So my point is, it's really important to bring idiosyncratic risk and reward elements into a portfolio that are beyond just stocks and bonds, particularly when we have now an expensive stock market. That really reduces the volatility, right? So it makes it a much smoother ride. You're not taking money out at those extreme drawdowns. So it's extremely important when someone's tilting towards that non-accumulation phase of life to strip out and have that three-dimensional feel, I think, to the portfolio.
That is something we've seen at Stallion Capital. A lot of people like the kind of smooth, consistent return that they get with our real estate focused in Texas. And, a lot of our investors are also Texas people, so they love Texas real estate.
Of course.
And, yeah.
So do Californians. I don't know if you're aware.
Yeah.
I don't know if you noticed. Yeah. Yeah, you're in Austin. You're seeing it for sure. Yeah.
We are seeing it. We are seeing it. And yeah, we've seen that kind of smoothing out the returns, getting that consistent, but also that kind of point of not touching the principal. Like you get that quarterly distribution, your principal can grow, or you can reinvest those distributions. But a lot of people actually rely on the income that they're getting from Stallion quarterly, and it's not dipping into that principal, if you will. So
yeah, it's just important to, like I'm sure you guys work with wealth managers and to have a process to evaluate. There's so much out there, right? You just really, I think, need to understand what you're investing in, what's the model, where are the risks, and there's risk in everything. And I'm sure you guys work with some great folks that have that process. So I think it's key, particularly in like the Reg D private fund space, to just, obviously you could just know someone and trust them, but it's important to understand and look under the hood and know what the legal documents dictate and know what you're buying, know what you're signing up for.
Yeah, no, absolutely. Looking under the hood is important. And trust, I feel like trust is kind of the basic foundation, right? It's not the thing that you make the decision on, but once you know you can trust the sponsor, then it's like, okay, let's dig in deep. Where's the accountability, the what's in it for you, really understanding that process. And speaking of that, we do, when you're diving into that process, you've talked a lot about alts. You're the director of alts over at Zermatt. And what is your kind of process for evaluating those alts? Where do you start? What does the middle look like? And how do you finish?
Well, I benefit from a lot of time in the space. So the peer group and network is extremely valuable in terms of sourcing. There's a couple conferences that I like a lot where they're kind of really well done, focused speed dating. So like in 2 days, you meet, what's called 16 funds coming into market from managers you might not know. So I kind of mix those in as well. So that's sort of that sourcing element. It really comes, I know a lot of the names already. I know who's done it before, who I think is going to do it again in particular areas. And then, when you branch out into new spaces, it's still coming typically through your peer group and network, right? So when you're moving into minerals, like we started investing in a mine, critical earth, raw mineral mine, rare earth mine. So that came through like really trusted source. And then beyond that, obviously it's a legal review, an understanding of the financial history of the key principals and their legal history. It's a legal review of the documentation. And then obviously you got to review the PPM. If you look at the risk section, they are naming more risk than they probably should because of litigation and laws and protection. But at the end of the day, the risks are in there, right? So it's really understand how leverage can be used and affect a portfolio. And then beyond that, you do have to, I think, have some sort of overall understanding that the strategy, the asset class is like kind of where the puck is going. So right now, for instance, we've been underweight commercial real estate since 2021 on the equity side. We've been favoring the debt side, obviously, because there's a huge pullback in traditional banking lending to good real estate assets. So you can pick up much more yield. That's kind of an asymmetric risk reward equation. But, we're dipping our toes right now. We think the puck is clearly there on equity parts of commercial real estate. So we just started committing to a private REIT that has a really established track record. They're doing 9% unlevered cash on long-term leases, good tenants, build-to-suit projects. So mostly all industrial buildings. So for the first time, we're like excited. Like that's such a higher spread for that lack of liquidity over U.S. Treasuries or corporate bonds. It's, and there's no leverage there, right? So yeah, I think it's that whole picture of what can go wrong, understand what can go wrong, and almost work backwards from there.
Absolutely. And I've talked with Vincent a lot. He's our CIO over at Stallion. And he says, we're primarily residential over here, but if there's anywhere you want to be in commercial, it is that kind of industrial or light industrial spot. So it's a good thing that
But that spooks you too, right? Because that's what everyone's telling you. But yeah, I mean, 9% cash on levered, go on a long lease with rent ups. I'll take it from a good sponsor. We're in. So we dipped our toes in. I think in real estate, beyond private debt, which you guys do, I think there continues. I think that's going to be like a 2-3 year continued runway of, and I'm sure there's always opportunity of just where like the risk reward's better than it ever has been in terms of the loan to value, the types of deals, the projects, et cetera, the guarantor, whatever it is. We're also starting to commit to opportunistic real estate. So I think there will be more and more distress. I think there'll be more and more workouts. So it's good to find a manager that can play all across the capital stack, special situations, equity, all the way through distressed debt. So that's another kind of area in real estate that we're starting to ramp up on.
Yeah, absolutely. No, the opportunistic side of things, especially given the climate, all the stuff we've talked to in this podcast, that is a smart move right there. And so we talked about the role of alts. We talked a little bit about how you evaluate it, a lot of legal stuff, a lot of getting referrals to specific alternative investments from your peer group. Tell me about 2 to 3 specific alts that you find interesting and you want to learn more about for 2024, or 1 to 2, however many you have.
Well, I'm always wrestling with digital assets where we've dabbled. I think I need to like reset and recalibrate my views and opinions on that asset class, which I think is a real asset class. So I think, in the public side, like the cryptocurrencies, you can really do like old school macro and systematic trend following. It's kind of the wild west, whereas that's a little harder in the stock market these days. So I think there's some fund managers that I should probably be looking at that have done well, or even a fund of funds. And there's some ones that have been out there a little while now. They've been track records. They've been through many cycles. And then I think on the digital asset side, we have a little bit of exposure through our venture and growth managers. I think just underwriting, not the coin, but the actual equity ownership of whatever the business is. I think there's probably some really transformative technologies that are being more and more adopted. So that's somewhere where I've more let our venture managers dabble in it for us. But that probably could be expressed more specifically, but I really need to recalibrate my belief in the asset class and get out of the news and restudy it. I haven't had a tremendous amount of client demand, to be honest with you, on that front. The other area is a tricky thing is distressed corporate credit. So I that is ticking up. We're past, I think, pre-COVID distress levels in corporate debt back to 2018, which was on an uptick. So the challenge with distressed debt is you commit to these funds, they tend to charge you a nominal fee on committed capital, and your money never gets called, right? So there's working out through a combination of whether it be a hedge fund that plays in distress, but also stress to rescue lending and high yield. So you're always kind of getting a return stream there. I do feel like it might be time to commit capital to some actual dedicated drawdown distress managers. So that's something we're looking into for this year.
I gotcha.
And mineral rights. I think the oil and gas game has got a long runway. Places like Texas and Oklahoma and Pennsylvania. So there's a lot to be done there as well.
Are there specific investments that have come your way through the network, or are you just kind of seeking out managers in that space?
We haven't really sought them out yet, but I would go, through my network to identify them. Marketing gets to me too. Every now and then a phone call with a good email. I'm more email driven. So if you're an asset manager trying to talk to me, send me a good email. I manage a lot of clients. So it's hard. You don't want your day blown up, right? But I get it. So I think every now and then, a fund does percolate its way up that I was unaware of. It's off the radar. That has a lot of merit for sure.
Well, we've talked a lot about the investment side of things, but are there any non-investment areas that high net worth individuals or people listening to this show should really be focused on 2024 and just life general going forward?
I think mental health and physical health have become more important than ever. I think kind of the post-COVID landscape. I see a lot of people watching a lot of news all day in my client base. So I try to tell them 30 minutes max a day. So it just seems like people should just check in with themselves. Friends should check in with each other just from like a psychological health perspective. Work out, be healthy. So I think you're seeing more and more people kind of talk out about that stuff. That's just basic, right? But I do think that went by the wayside for a couple of years, and we're still kind of climbing out of that. I think most acutely, like the estate tax exemptions are about to be cut in half. So if you're hoping, so basically it's like 22.5, I think, for a married couple, maybe it's like 11 something for an individual. That's going down to 5 and 10, let's call it, or 11. So like people really need to revisit their estate planning and make sure that their design and dreams and wishes are going where they want to go and not to the U.S. government when they pass away. So I would urgently encourage people to revisit. Assets have grown different ways and shrunk. Like you really need to look through that planning. It's easy to model out. We do it all the time for even prospective clients as part of a way to get to know us, is to just really map what you got, what structures you have in place, and laws change. So, and then what I've shockingly see, we think taxes are going to go up. And I hate to say that. So if
that
you
is
look
a tragedy.
It's really, I don't know how the math works, right? So if we have higher rates than we used to have for longer, and we're servicing our own interests as a government. If we do get some sort of recession and you have lower tax revenue, just based on the current structure, and then it's really politically unpopular to decrease spending and to really get in line in terms of a budget. There's no solution right now. So the only solution, the easiest thing to do is just, up the rake on individuals. That could be the estate tax, it could be corporate tax, it could be all these different things. So at the end of the day, I think I've shockingly have come across large clients. They've spent tens of thousands of dollars to build these exotic estate planning structures. Please talk to us before you do that. They've been sold these structures, they never funded them, right? So an irrevocable trust, a private placement life insurance policy, that's a time value money game in terms of its benefit. So you spend all this money and then you really fund the thing because you don't have someone who's sitting on top of your whole picture, who's paying attention to it, who's pushing you. By the way, it's the last thing any client wants to deal with is like their estate plan. So it's a time value money game. If you create a structure, have someone look at it again if it's been a little while and get it funded with whatever you want funded with, because it's all a growth after funding game. I think taxes are going to go up. People need to be prepared for that.
So not only do we need to be paying attention to physical and mental health, which I can speak to a little bit because I'm young, but even post everything that's happened I got to working really hard, planning for my future, and my eyes have just been burning. My head has been hurting, and it's like just getting outside, playing some pickleball, spending some time with some friends, being held accountable to that exercise. It does a lot for your health. So let's not belittle that. But then also kind of preparing for that kind of tax hike that may or may not happen, as well as making sure your estate plan is being managed actively or somebody's on top of it consistently. I gotcha.
That's up to date and that's funded. I mean, I'm telling you, time value money. It's all math.
Well, I'm sad that you have predicted the tax hike, but I see the reasoning there, and my emotions have nothing to do with it. So there we go. Well,
hey, there's always tax mitigation strategies. Okay, so
very true.
There tends to be different opportunities. You just got to pay attention and seek them out.
Very true. Very true. Well, Andrew, we're going to jump into the last section of the show now, and this is where we really want to come back to you, come back to your firm. So tell us a little bit. I think, honestly, people have gotten a good picture of it, how they can tell you apart from other financial advisors just from this episode. But what are the 1 to 2 things that really set you guys apart from other financial advisors?
Yeah, I think the best way to get loyal, big, complicated clients is to have an immediate economic impact on their life once they start working with you. So it's really our goal to ferret that opportunity out, and there can be multiple opportunities. Like, for example, you could have a client who's been like on a 9% large line of credit when rates were low and their financial advisor wasn't paying attention, wasn't reshopping it. So you can, like we negotiate a line of credit from, I think it was 9 on $2 million down to 2.25 fixed for a year when we took the client on. That's just one example. If a client has there's a lot of tax mitigation opportunity in the tax code. If someone wants to go in the red and risk, I'm not that comfortable with that, right? So my job is to be like, look, I've seen this before. This doesn't tend to work out, right? So understand what you're getting yourself into. But within the legal tax code, there's always a bird in the hand. So whether it was opportunity zones on capital gains, but doing it right, with right diversification, with really good underwriting, with really good due diligence. So that allows you, it still does, to defer a capital gain for several years. And then if you hang on to the investment, all the growth tax free. Another example would be like if you have a lot of passive income last year, like you own a lot of real estate and you're getting a lot of passive income. It's a particular section of your tax return you can look at to see if you do have passive income. There's a 2-to-1 write-off by investing in sale leaseback, gas stations, truck stops, and motor fuel type properties right off your income. And they're good assets. So you could literally take a 2-to-1 write-off against passive income by investing in what we thought was a really good investment. So those are just some examples. 401ks can be a mess. Employers have so much control if you're a small business owner or middle market business owner over how your 401k is structured. There's some tweaks you can make right away there. And then cutting out needless costs in your portfolio is obvious layup, right? If you're paying this fund that's giving you the same thing that this fund could give, but it costs 20% more. Those are examples.
Yeah.
So we don't want to like charge the cheapest fee in the industry because I don't think we can do everything we do for people by not charging a fair fee. So I think just immediately economically impacting a new client and measuring that for them, I think is super valuable. Yeah. Beyond that, it's, clarity, communication, and trust, right? So you've really got to, like any business relationship with clients, you've really got to get to the bottom, what's motivating maybe what they want to do, unpack that, provide data on why or why not that might hurt their financial picture, and just really clearly communicate it so everyone's kind of on the same side of the table.
Would you say that communication is the most important aspect of the client-advisor relationship, or would you say there's something else there that you think takes priority?
Yeah, I think like we said, trust is like, first base, right? But I think clarity it's really, I've learned, like I've had miscommunications where the client, either me or the client's not communicating right. You got to get eye to eye. You got to have very good clarity with clients on what's driving everything.
Absolutely. Well, Andrew, I think that's all we have for you on the show today. Thanks so much for coming on.
My pleasure. Appreciated the opportunity to be seen and talk to you. It's fun.
Of course. Yeah, it was a great time. And if people want to know more about you, where's the best place for them to go?
Zermattwealth.com. Zermatt Wealth Partners, I think, or ZermattWealth.com is probably the easiest website. There's a lot of information about what I've discussed today and more. 619-487-0808 is our general line. Someone will pick it up. And LinkedIn. So I'm pretty active in LinkedIn. Andrew Jensen at Zermatt Wealth. You can find me. I think those are the best paths.
Fantastic. I thought you were about to drop your personal cell number there. I was like, dang, he's on.
That's rough. No, that's rough. Yeah.
Yeah. Well, cool. Thank you guys for watching. All the ways to contact Andrew will be down in the show notes, and we'll see you guys on the next one.
Thanks, Timothy.